Hey traders, welcome back to Learn ICT with Kiki. In this video, I'm going to explain what liquidity is in the simplest possible way, so even a brand new beginner can understand it. We're going to talk about equal highs and equal lows, swing highs and swing lows, trendline liquidity, and why the market keeps taking your stops. By the end, you'll finally understand why price moves the way it does and how to recharge the same way smart money does. So let's get started. So what is liquidity? Liquidity is just a fancy word for money sitting above or below price. That money comes from stop losses and pending orders that traders place around obvious levels. Think of liquidity like a pile of cash on a chart. Wherever traders put their stop losses, that's where the money is. And the market loves money. Price will go out of its way to grab that money before making a real move. We'll start with the most basic form of liquidity, which are swing highs and swing lows. So what is a swing high? A swing high is a point on a chart where price pushed up, paused, and then pushed back down. Think of a little mountain peak. Above that peak, what do most traders put? Stop losses. So above every swing high is buy-side liquidity, money waiting to be taken. What is a swing low? This is the opposite, a dip in price before it moves back up. Below swing lows are sell-side liquidity, more money sitting there. And why does this even matter? When you see price quickly tap above a swing high and then drop, or poke below a swing low and then shoot up, that wasn't by accident. That was a liquidity raid. The markets grabbed the money and then moved away. Now let's talk about equal highs and equal lows. This is one of ICT's favorite types of liquidity. Equal highs is when the market creates two or more highs at almost the same exact level. Beginners think price rejected here twice is strong resistance. So what do? They sell at those highs, or they place stop losses right above them. Now we have a perfect cash pile sitting above that level. Smart money sees this and says, thanks, I'll take that. So price pops above the equal highs, grabs the stops, and then moves in its real direction. Equal lows are the same thing, but at the bottom. Beginners buy off the equal lows and put stops right underneath. This creates a pool of sell-side liquidity. The market dips down, scoops the stops, and then moves away. An easy way to remember would be equal highs equal money above and equal lows equal money below. The last form of liquidity that we'll be discussing is trendline liquidity. Trend lines are one of the biggest traps for retail traders. When retail traders draw a trend line, every time price touches the trend line, they buy the bounce or sell the bounce and put their stop losses right underneath or right above it. What does that create? A long line of liquidity running under the trend line. Imagine a line full of stop losses, like little coins sitting in a row. At some point, price will pierce through the trend line, wipe out all of the stops, and then go in the real direction. Trend lines don't break because they failed. They break because the market needed the liquidity hiding behind them. So why does price take liquidity? The market moves on purpose. It doesn't just run your stops because it hates you. Here's the truth. Price needs liquidity to move. If price wants to go up, it first goes down to grab sell stops because those stops turn into buy orders, and buy orders fuel upward movement. If price wants to drop, it first goes to take buy stops because buy stop turns into sell orders, which fuel downward movement. This is why you see stop hunts right before a big move. An easy way to remember is that price runs to liquidity before it runs to its real target. Let's recap in the simplest way. Swing highs and swing lows equal small pockets of liquidity. Equal highs and equal lows are big, obvious liquidity pools. Trend lines are like long trails of liquidity. Price always grabs liquidity before making the real move. Once you can identify where the stops are, you'll start seeing the market completely different. Instead of thinking the market rejected a level, you'll realize it was just taking money and then moving to the actual destination. If this helps simplify liquidity for you, hit the like button so YouTube knows to push this to more traders. Let me know in the comments if you want a full video on liquidity sweeps and entries and how to trade the sweep and displacement setup step by step. Thanks for watching, and I'll see you in the next one.